Hello, my name is Jesse Blocher, and this is my paper, Endogenous Short Selling Constraints, Who is Buying When Shorts Are Selling? This is joint work with Chi Zhang at Temple University. So the main point of this paper is to investigate why does a stock become special, but to look at it through the lens of supply rather than demand. So we know from the literature already that when demand goes up, we would expect to see that prices would go up, right? That this is honestly basically supply and demand, that holding all else equal, right? As demand goes up for loans, loan fees would go up. But we know from my work with Adam Reed and Ed Van Wessup, and even intuitively prior to that, we build on the Miller 77 paper, that the lending market and the stock market are linked. Okay, that when you have a beneficial owner, say a mutual fund or a pension fund or some other owner, they're going to lend their stock in the lending market, they're going to sell it to a short seller. And that short seller, in turn, is going to take that stock and sell it short back to some other new owner, right? But that owner themselves could in turn lend the stock to a short seller who in turn sells it to an owner who lends the stock, etc. And you can imagine if 100% of owners lend 100% of their stock 100% of the time, this is an infinite loop, and we actually don't have any short selling constraints. Okay, what we would have is we have an infinite supply of stock. Now, we don't see that because the beneficial owners, ultimately the shares come to rest with some beneficial owner who does not want to lend their stock or is constrained from lending their stock. So this was originally shown in Duffy 96, right? He studied treasuries and he showed that, argued that, actually really more assumed rather than showed, that the lending fees was really more like a convenience yield, right? It's kind of, or maybe a dividend, you can think of it as. And that in this framework, an owner would always want to lend. And the only reason why they wouldn't lend would be institutional constraints. Okay, Melissa Prado in her JFQA paper studied equities and basically found the same thing, that institutions buy stocks in order to obtain lending fees. And I have a paper with Bob Whaley where we study ETFs, exchange-traded funds, and show that these exchange-traded funds are operating a two-sided market model where they're playing both the securities lending revenue market as well as the investor market, and they're actually making more from their lending revenue than they are from their expense ratios. So really, these are all reasons why owners would want to lend stocks all the time. So the question is, why would they not lend? And the best answer we have is Duffy's original answer, right? Institutional constraints, that some owners, for some reasons, are prohibited from lending their stocks. But there's another side to this argument that makes sense, which is that equities, unlike treasury bills, are risky. They have, you can think of it as a cost of carry, right? The cost of carry for an equity security is that the price might go down, right? Treasuries are pretty safe, but equities may not be. And this cost of carry may dominate the so-called convenience yield of the securities lending fees, particularly because the reason why we're lending shares, why an owner is lending shares, is because a short seller wants to buy them. And short sellers are sophisticated, short sellers have information, which means the price is likely to go down. Okay? And that's what Evans, Ferreira, and Prado have shown in their 2015 working paper, which I think is now under review. They showed that mutual funds, okay, in general, that have the strategy of selling dominates the strategy of holding that stock and lending it. Okay? And the only reason why they don't sell is because they need to hold and lend because of fund family constraints. So again, we have an institutional constraint story, but it's a little bit different. Really, they should be selling because of this cost of carry idea, right? That the prices are going down. The prices are going down in expectation. It's a negative expected return, even with the lending revenue. Okay? So this begs the question, why would anyone want to hold and lend? Evans, Ferreira, and Prado say that mutual funds shouldn't. They don't. They underperform. They only do this because of other constraints. But an even better question is why would anyone buy? Why would anyone buy from short sellers if they know that short sellers have information and are willing to pay high lending fees in order to sell those stocks? This is illustrated in this diagram. So this is this normal distribution represents the density of investor beliefs. This is kind of a standard set of beliefs right here, of negative beliefs going up to positive beliefs. The so-called true cost would be in the middle, right? The average beliefs of all investors. And we know from Miller 77 and from others who have argued that when pessimists are blocked from the market, that we see overpricing, right? So That's what this is. We have this high price here. This is the kind of the market price that we see in the market. And so only these optimists here are willing to buy at that price because they think the actual stock price is higher than the current price. Given current borrowing costs that are showing up here, only these pessimists down here are willing to buy because they're willing to pay these borrowing costs to borrow the stock and then short it because they believe that the correct price is down here somewhere. Okay, so what we see is that these pessimists are going to borrow and short sell to these optimists because these optimists are the only ones that are willing to borrow at this higher price. And then the question is do these optimists in turn lend to the pessimists, or perhaps will they not? Now, what we're going to argue in this paper, what we find is that when a stock is on special, the marginal buyer, right, those optimists are also the marginal lenders. Right? In this same cycle that I described at the beginning, the buyer, when a stock is on special, right? Stock's on special, so utilization is very high. There's not a lot of shares available. It's expensive to borrow. And so these new buyers have a new set of shares that they can in turn lend. They become the marginal lender. And then importantly, what we show is that those marginal lenders lend much less frequently than on average, right? So if we're looking at the average rates of lending or the average shares that are supplied into the market by beneficial owners, these marginal lenders are lending much less. So really what this means is that we have the wrong null hypothesis. That's the argument that we're making in this paper. That as demand rises, the null hypothesis should be that expected supply rises also along with the lending rate. Okay, and that what we show is that actual supply falls short of this. So we call this supply shortfall. The actual supply falls short of what we would expect supply, how we would expect supply to expand if these marginal lenders were lending at exactly the same rate as the average lenders are. Okay, therefore these optimistic buyers are endogenously generating short selling constraints, hence the title of the paper. Okay, when we investigate these buyers, they seem to be extreme optimists. Okay, these optimists are counterbalancing the extreme pessimists of the short sellers. Now, what do we mean by extreme optimists? Well, what we show is that these stocks have increased lotteriness. And so what we're doing is we are linking this short selling literature of stocks that have negative expected returns to this preferences for positive skewness literature, which is a set of stocks that also have negative expected returns, but have positive skewness. Okay, and this was highlighted and really started by Barbaros and Huang in 2008. And there's a long literature on this positive skewness and lottery stocks right now. So really, when we're investigating these buyers, what do we find? Well, what we find is that over a shorter horizon, it seems to be a blend of retail and institutional investors. We investigate the net flow between them and basically find no effect over shorter time periods. This is 10 to 20 days, basically, is what we find here. Over longer periods, though, and this is really more like 30 trading days, what we find is that we do have significant buying from retail investors. So retail investors are net buying from institutional investors over longer periods of time. And that when we look at returns, it appears that what's happening is that these are mostly defensive behaviors. That we're not seeing anything like short squeezes or speculative bubbles. We're not seeing prices go up because of the failure to lend. Instead, what we're seeing is that the price is not adjusting downward the way we would expect it to if these marginal buyers were lending at the rate we would expect them to lend. So, roadmap, we're going to look at the data that we have. Then I'm going to explain lendable supply percent. This is a pretty important concept that I'm going to try to explain here. And then I'm going to discuss kind of our metaphor for this study, which are these transition matrices of stocks transitioning from cheap to expensive, expensive to cheap, etc. I'm going to discuss a little bit about utilization because I think that's a critique that could be an alternate explanation for our findings that I don't think is valid, and I'll show you why. And then we'll investigate a little bit more about who the buyers are of these special stocks. All right, so our data is pretty standard. We're looking at CRISP, Compustat, and Thomson Reuters. This is institutional ownership data. We're using data explorers, which is pretty common in the securities lending literature. The one data set that may be new to a lot of the audience here is this daily order flow data. It's not really primary to our main result, but it's part of our investigation of who these buyers are. This is net order flow data from the New York Stock Exchange that looks at the net order flow between retail and institutional investors. It's daily data that we purchased from the New York Stock Exchange. And we're looking at daily data from 2006 to 2013. All right, so let's talk about lendable supply percentage. This is the important concept that I want to get across, right? So the lendable supply percent, you've probably heard this called lendable supply or supply percent earlier. This is the total shares supplied. Okay, so this is shares available for loan divided by the total shares held by potential lenders. Now, in practical terms, this is going to be shares outstanding, right? So this is going to be SHROUT, right? Shares outstanding here, the denominator, and this is going to be supply from data explorers over here. So we can compute it. Our proxy is going to be to compute this on average. What is the average amount of shares supplied divided by shares outstanding? We can't really compute directly the marginal amount, right? So what we would like to be able to compute is, over a multiple day period, what are the shares supplied in the lending market divided by the total shares owned by potential lenders. But instead what we're going to compute is we're going to compute changes to this average percentage to then infer what's going on with the marginal. Okay, so remember, in the stock loan market, we would expect that when demand goes up, prices go up, all else equal. Okay, but we can't really hold all else equal. We cannot hold this lendable supply percentage and shares supplied. Both cannot be held equal unless we have the trivial situation where lendable supply is equal to 0. Here's why. We have a beneficial owner who's going to lend their stock to a short seller. And this short seller is going to, in turn, sell their stock to new owners, and those owners can, again, lend back to short sellers, right? So what we would expect is that with every single, if there is a positive lendable supply, right, even if it's 1%, some number of shares with every short sale are going to be, in turn, supplied in the stock loan market. Okay, so shares supplied should not be flat. It shouldn't be 0 as short sellers are buying, because some percentage of those shares are going to in turn find themselves back in the stock loan market. Let's look at an example to make this a little bit more concrete. Okay, so remember, we're talking about stocks that are on special, so let's go assume that utilization is high. I'm going to deal with utilization later. We're going to hold lendable supply constant. If that's constant, then share supply should expand like a geometric series. Okay, so here's what I mean. Let's assume that that number is 50%. Okay, if beneficial owners are going to lend 100 shares, those shares are sold short. Then of those 100 shares, 50 in turn are lent. Those 50 are sold short. Those 50, 25% are then lent, which are then sold short. This is what I mean by the geometric series expansion. Okay, and what we see then is for this 50%, if we expand to infinity, a short sale of 100 shares generates an additional 100 shares of supply, a 100% increase. But after just 5 iterations, what we see is that it's already 93%. Okay, and that's what this table over here is showing. For these starting points of the lendable supply percentage, you can see after just 5 iterations how quickly supply is expanding, right? Even here, if we have a starting percentage of 55, 60, 65% after just 5 percentages, we've exceeded the original amount because of this supply expansion. And so what we're arguing is that it is this geometric series expansion going on in this table that really should be our null hypothesis of what we expect from the supply side of this transaction. Supply is not static. It can't be static if we're assuming some positive lending supply percentage. So let's look at the framework in which we're going to investigate these transition matrices. So we're trying to measure specialness events, right? So what we're trying to say is that we have some stock loans here are cheap, right? And we're using the daily cost to borrow score, the DCBS, which is in the Data Explorer's data. You can look at that data to find out what that is. It's a bin from 1 to 10 that plots how expensive stocks are. So higher bins have more expensive stocks in them. Okay, so because of the way that data is distributed, we're going to say that a bin of 1, if that moving average is 1, then it's cheap. That means that it stayed in DCBS 1 over the entire period. Those are cheap stocks. And then we're going to look at changes to what we're going to call up here is going to be expensive, and down here is going to be I'm sorry, that's not cheap. That's going to be moderate. Is going to be down here. Our moderate threshold is just 1.5. So you can see DCBS moving average of 1 is cheap, 1.5 is moderate. Anything more than 1.5 is expensive. We do have some robustness to this 1.5 threshold. It's somewhat arbitrary. We're using 1.5 here because it's the median of the data set. If we do 1.85, that makes our moderate and expensive bins of equal size, and we get basically the same thing. So what we're going to do is we're going to investigate basically this period here compared to this period here. We're going to look at transitions between them so that we can look at average moves from stocks that are basically cheap to stocks that are basically expensive. And you can see why here, that if stocks are moving around, and they are, if you look at the data, there's different levels of specialness. We don't want to pick up some spurious results, say, of these dips down here and then going up to here, because it was kind of already in this state where it was special. So we're trying to smooth the data by looking at these moving averages. Okay, so we're going to look at these transition matrices. So to get an idea of what the data look like, I've posted here a table of summary statistics of these transition matrices. Okay, and so what we can see here is that really two groups that we're sort of ignoring here are the very large cap stocks. So this first group here is market cap. These are the large market cap stocks. You can see this is $4 billion here. These are in thousands. So this is $4 billion. These are the on average, the most largest cap stock. And here's where our smallest cap stock is. And really all the ones in the middle are in this group here that are seeing some movement between moderate to expensive, or maybe they're staying at moderate for a while. The cells we care about the most is this cheap to expensive cell and the expensive to cheap cell. Those are the ones we're going to be focusing on. But what I want to show you is that we're not looking at extreme stocks here. These are not extremely small or extremely illiquid stocks. You can see that down here. Here's our dollar volume. Here's our annualized volatility. We see the same pattern here, where we have our most liquid stocks here, our least liquid stocks here, and then we have the big massive middle here. Same thing with volatility. We have very low volatility stocks here, high volatility stocks here, and then we have the big middle kind of in this group. And we see that pattern across. And so what we're going to be paying attention to, again, is going to be the corners of these distributions. But I wanted to show you what our summary stats look like so you understand a little bit about what our sample looks like here when we're talking about these stocks that are transitioning from cheap to expensive. So how are we going to measure this? We're going to measure this by looking at changes, right, from the previous period to the new period, right? So here's the to period is here. Here's the from period, right? So here's the past 10. Here's the future. And then we're going to divide by the midpoint because we're looking at these transition matrices. We need the symmetry. That's why we're using the midpoint. Our results are robust to that. You get some weird results if you don't use the midpoint, because you can have some very extreme movements up and down because these distributions are truncated at the bottom. You can't have demand less than 0, for instance. And so you can get some very extreme movements because of that. And that we also, because we're using the midpoint, we get rid of some of that. We also Winsorize the distributions to make sure we're not getting anything weird. This is an example for demand, but we're going to do the same thing with supply and with lending fees. Now, importantly, we're going to put these in regressions. Why are we going to put these in regressions? Well, we're going to create indicator variables for each cell, each of the 9 cells of those transition matrices. And the dependent variable, the only thing on the right-hand side is these indicator variables. The dependent variable is going to be X. It's going to be the demand, supply, lending fee, etc. The reason why we're doing that is because we need to double cluster our standard errors. Our standard errors are going to have a lot of bias in them because we're using this smoothing procedure. Remember, we're using daily data, okay? And that daily data is going to happen over 10-day, 20-day, or 30-day periods. And because we're using daily data, we know that those standard errors are going to be biased. And so we double cluster the results we reported by firm month, but it's robust to that. We can use different clustering methods and get basically the same results. But that really brings our standard errors down a lot. It moves them up a lot to bring our t-stats down a lot to make them more reasonable. That's why we're going to do a regression. So all the results we're going to present are going to be in this regression framework. So here's our basic result, or at least the first part of our basic result. It needs a little bit of interpretation. But this is the same transition matrix. This is just one. So this is a 9x9 cell. So this is our upper right cell here. So what we're looking at here is a 16% expansion in demand. Over here, we're looking at a 0.58% expansion in supply, and these two go together as stocks are transitioning from cheap to expensive. Okay, we can look at the symmetric result down here as stocks are transitioning from expensive to cheap, right? So we see demand dropping, we see supply actually expanding, and so we would expect to see lending fees drop. But what's interesting here is that we see demand expanding, we see supply doing nothing. This is the result in the literature, right? This is the Cohen, Diether, and Malloy result. They look at stock prices, but it's basically the same thing, showing that really all the action in stock loan markets seems to be coming from the demand side, that we have big expansions in demand and supply is flat. But remember, my argument is that this is the wrong null hypothesis. This is assuming a null hypothesis of 0, and that's the wrong null hypothesis. The correct null hypothesis should take into account the expected expansion in supply, which is what we're computing here. So what we're going to take is we're going to take this demand change here, and that demand change, and we're going to multiply that by this lendable supply percentage at different levels. We're going to look at the 25th percentile, 50th, and 75th percentile down here, and here's what those distributions are, kind of in the whole sample. So we're going to multiply this demand by this lendable supply to find out what is the expected supply. The expected supply here is 1.46, which is a lot more than the 0.58%, right? It's 0.88% here, right? And so this 0.88% is what we would expect. This is what the supply shortfall is, right? This is how much supply falls short of what our expected supply is. And I didn't show this in the previous graph, but we see similar things with the 20-day and 30-day here. Looking at even higher expected supply shortfalls of 2.13 and 3.5%. And then if we met, and this is using a very modest assumption of the 25th percentile of the lendable supply percentage. If we look at something more middle of the road here, right? If we look here at this 50th percentile in the middle, we see that the supply shortfall is more like 2, 5, or even 8%. And so what we're trying to argue here is that supply is not expanding at the rate we would expect, given what we know about how supply should expand as demand is rising, right? Given a held constant, on average, lendable supply percent. And so what we're arguing here is that this shortfall in supply is at least partly responsible for increases in lending fees. And we see that these are large and statistically significant. Remember, these are changes, so for instance, this 12.42%, this is a shift in the average supply, right? So that doesn't tell us anything about the margin, right? We're just looking at how the averages are shifting. The margin must be shifting much more if we're seeing this shift in the overall supply. So it could be that utilization is an explanation for this, right? So utilization, if utilization, for instance, was very, very low, right, we would expect to see demand go up, and we don't necessarily need to see a supply response. The thing is, we're talking about stocks that are expensive to borrow, and so really we're talking about this group of stocks here. We're not talking about the DCBS equals 1 stocks. So this is the daily cost to borrow score. This is a factor of how expensive stocks are to borrow. We see the vast majority of observations are in DCBS equals 1, which is known in the literature. But then what we see is that the utilization is very high, right? 41% and up in this stock. If we look at the medians over here, we're talking about 40% and up. So mostly we're talking about high utilization stocks anytime we're talking about these stocks that are expensive to borrow. And then we also can show in the same transition matrix framework that what we see is that these stocks become much, much higher utilization. This is exactly as we would expect, right? We know that utilization is highly correlated with lending fees. So we would expect that as lending fees are going up, which is really what we're measuring here, utilization goes up, and then it correspondingly goes down as lending fees are going down. We see this both in the 10-day period, the 20-day period, and the 30-day period, which I haven't shown here. So who are these marginal buyers? Who are these people that are buying these stocks? We're arguing that these are extreme pessimists, short sellers, who are selling to extreme optimists. Now they have to be extreme pessimists because they're willing to pay high fees, and they have to be extreme optimists because the stock is already overpriced. But we know that there is this literature that there are buyers who exhibit a preference for positive skewness. So what we're going to do, our measure of skewness is going to be this lotteriness measure of Bali, Kakichi, and Whitelaw, 2011. It's a JFE paper. What we're showing over here is just their max 1 measure, which is the maximum return over a 1-month period. We measure that over 22 trading days, which makes sense, remember, because we've got 10-day periods here. We're doing a 10 and a 10. So this right here is an overall a 20-day period. And what we see is a 3.4% increase in the lotteriness of a stock as it is transitioning from cheap to expensive, right? Cheap to expensive. And down here over a 20-day period, we see a similar 9.5% increase as it's moving from cheap to expensive. And simultaneously over that longer period, we see a decrease when it's moving from expensive to cheap, right? Expensive to cheap, see a negative 5.9% decrease. So this is showing a symmetric response of stocks that are moving from cheap to expensive show an increase in their lotteriness of almost 10%, which I think is rather large. I don't know what your prior is, but that strikes me as a rather large increase in the lotteriness of a stock, showing that these stocks, which we know have a negative expected return, we know that stocks that are short constrained have negative expected returns. That's what we would expect with stocks that have positive skewness, and that is known in this literature. So what we're doing is we're connecting the two literatures, the lotteriness, the positive skewness literature, along with the short selling literature, that they may be the same group of stocks. We also look at the net individual trading. We're pulling this from this Keneal, Sarr, and Titman paper. This is a JF 2008 paper. This is net order flow from institutional to retail investors. If we look, I'm showing a 20-day period here, the same as for the 10-day period. We really don't see much in the way of shifts in order flow. We do see the reverse, right? That when stocks are going from expensive to cheap, we see big movements. This negative number means the flow is going from retail to institutional. What we see here, though, is that as stocks are going from cheap to expensive, that we see over a 30-day period, we see strong movements of retail buying, net retail buying from institutions. Okay, so that fits. We don't see much, unfortunately, in the shorter time periods, but over the long time periods, we do see a strong retail participation in this, which fits the literature of lotteriness and preference for positive skewness. Kumar 2009 shows that it is retail investors that primarily seem to have a preference for lottery stocks. That's a pretty well-established result in the literature. So the question is what is the motivation? You can think of two different things that are going on here. One is that a buyer is not going to lend because they want to generate some sort of a short squeeze or some sort of speculative bubble, or it could be a defensive move where the stock maybe is already overpriced and the owner is not lending in order to limit the downward pressure on the price. And we find evidence for the latter. What we find is that in general, the CARs, the cumulative abnormal returns over these periods are zero. There's nothing going on. There's no return events happening here. And that's because we think what's happening is not that they're generating some pop, right? So this is not some movement upward and then downward where we're seeing some sort of a short squeeze or some other bubble. What we find instead is nothing going on. So we see this as evidence for more defensive movements here of just trying to limit the downside of what's happening and hold on for maybe a possible pop later in this positive skewness literature. Finally, what we looked at is IPO lockup. So this is an interesting setup where it's known from the Ghezi, Musto, and Reed paper in 2002 that IPOs are short sale constrained, right? That IPOs have just come out. There's not a lot of supply available. There is this lockup where insiders cannot sell their shares. They also can't lend them. So what you see is that IPOs, this is part of the reason why IPOs have a tendency to be overpriced initially, is that there's no lending market for them or a very minimal lending market for them. So what we look at is we look at the expiration dates on these. And when we look at the expiration dates, what we find is that there is over 10-day periods, we do see a little, so when we see supply move up, we see demand move up, we see a little bit of a fee move up. Now, what we have not done is we have not corrected the T-stats here. So these are uncorrected T-stats, so they're probably a little bit high. Once we correct them, I expect this T-stat is going to drop below significance. And so what we're going to see is this is going to be not significantly different from zero as we see supply and demand moving together. Over longer periods of time, what we see is that supply goes up, demand goes up, and actually fees go down. And so what we're seeing here is that, again, evidence for kind of the opposite of our story. We see this as sort of a mirror image that as we see supply really expanding because of these expirations of lockup, even though demand is going up, so normally demand going up we would associate with higher fees, but because supply is going up by so much more, instead what we see is we see fees going down. And we see the same thing over 30-day periods as well. We see big expansions in supply. We also see expansions in demand, but supply wins out, right? That what we see instead is drops in fees over these periods. This is a relatively small data set, so we don't want to draw too much from this, but this does seem to tell a symmetric story to ours, that supply expansions can drive down fees in the same way that we're arguing that supply contractions can drive up fees. So overall conclusions, what we have shown, or what I hope we have shown and hope we have convinced you of, is that restrictions of supply at the margin also helps drive higher lending rates. Now, hear me, what we're not saying is that supply is a primary driver of lending rates. We still believe definitely, and our data shows, if you look at the movements in demand, the movements in demand are substantial. If you're thinking about what is the primary driver of lending rates, it still is going to be demand. What we're saying is that restrictions in supply also matter at the margin. That there are suppliers out there that are choosing these marginal buyers as stocks become special. They are the marginal lenders, and they are lending at a lower rate than the overall average in order to generate additional short selling constraints in order to support the price of these stocks. And these buyers are these extreme optimists and very likely retail investors. It seems like we have some evidence that the retail investors, not 100%, but we have some evidence that they're retail investors, which fits with the story that these are investors that have a preference for positive skewness or lottery stocks. Okay, and finally, we don't see a lot of evidence around returns, and so what we think is going on is that this is probably more defensive behavior, trying to avoid negative pressure on their stocks rather than anything like a short squeeze or anything like some sort of speculative bubble. All right, thank you very much for your attention.